Hey everybody, Smart Silver Stacker here. Today is Tuesday, June 28th, 2022, and there are a lot of developments in the global economy so far this week. Lots of news. Had some stuff coming out of the G7. We're going to talk about a number of those stories, and also just going to kind of give you an overview of a number of things that are going on in the world at the moment. I'll be covering several stories, so bear with me in this video. Stick around to the end though, because all of the stories that I'm presenting today are interesting in their own right, but when you look at them together, I think that there's a big picture that is developing, which is going to be very relevant for precious metals and inflation and the global economy moving forward. First off, we got this story. The G7, they had that meeting in Munich, and they announced a ban on Russian gold imports. And this is kind of an odd token move, if you ask me. I suppose it could have the immediate effect of driving gold prices somewhat higher in the West amongst these G7 nations, but at the end of the day, it's kind of hard to understand how they're going to prevent the importation of Russian gold, as other buyers are just going to step in and snap up the Russian gold, you know, China and India, other BRICS nations, and then I don't know what's to stop them from just re-smelting that gold and selling it to G7 member nations, and how they would know the difference. There's nothing special about Russian gold that makes it identifiable in any way, really, so gold being the fungible asset that it is, it's hard to see this being anything more than a token move. But I think it does tell you something about the mindset of these G7 nations and their leadership. And this was another one out of that Munich meeting that the G7 just wrapped up. They are looking to cap the price of Russian oil, and this one, kind of an odd one if you ask me. It almost seems like the leadership of the G7 is getting a little unhinged with this kind of stuff, because I just don't know how they plan to implement this. I mean, what they're talking about is capping the price that other nations can pay for Russian oil. And I mean, the EU is already not importing Russian crude, or they will have fully implemented that embargo by the end of the year. So I don't see how they're going to have much say in the price of Russian oil, and how the G7 intends to affect how other countries like India and China are paying for Russian oil is beyond me. I mean, maybe they have some convoluted mechanism in mind, but I would be shocked if they were able to actually get this to work. But what this does reveal, I mean, it seems to me like the leadership of the G7 is kind of surprised maybe that the existing sanctions that they've implemented so far hasn't completely brought the Russian economy to its knees. And it's not that the Russian economy isn't suffering. I'm sure that they're having, you know, inflation and supply chain issues there like the rest of the world, but they're also getting record revenues from oil and gas shipments to India and China, who have been more than happy to snap up cheap gas and oil from Russia as the West has stopped importing that stuff. And I mean, that's no surprise. If you can get Russian energy at a discount, why wouldn't you buy it? That just gives you a competitive advantage in the global marketplace. And this has been such a significant move that now Russia is China's main supplier of oil. They've even surpassed Saudi Arabia at this point. And so that's a trend that I don't think is going to stop anytime soon. As long as this Western embargo on Russian energy continues, it's just going to be to the benefit of the Chinese and the Indians, who are going to get cheap Russian gas. And, you know, the Russians, they're going to have to sell that stuff at a discount, but you got to keep in mind they're selling it at a discount to an already highly elevated price. And so, you know, like we saw, they're getting record oil revenues. So this idea that the G7 is going to be able to control what these other nations are paying, I think is a bit of a pipe dream, but we will see how that plays out. But, you know, one thing it does tell us is that this conflict between the West and Russia is escalating, and that is pretty important, because that is going to lead to a lot of inflation. And I'll be getting into that in just a few minutes. But first, I also wanted to cover this G7 announcement that they are implementing a $600 billion infrastructure plan to rival China's Belt and Road. And so this just shows that a real focus of the leadership of these G7 nations is the conflict between East and West, and they are trying to stand up to the competition from the Chinese and the Russians. You know, and maybe this plan will help somewhat, although I suspect that probably that $600 billion is just going to lead to more inflation, because you got to keep in mind, all of these nations are pretty much bankrupt. All of the spending is being financed by debt, and the more they borrow and spend, the more that is going to contribute to rising inflation. Now, there was also this story about Russia sliding into a historic debt default, and it seemed like a lot was being made of this story in the Western media, although, you know, they've been reporting on this for several months now, and it seems like Russia has the money to pay their debts. And Russia, as far as debts go, it doesn't really have a tremendous amount of national debt. I think that their debt to GDP ratio is like under 30% or something like that. I mean, they carry way less debt than a lot of these Western nations. And so, them defaulting, not a big deal because they don't rely on credit markets that much. They're paying cash for a lot of things, and they have revenue from energy. It seems like this isn't really even a default in the traditional sense because Russia could pay. They're just being blocked from making these payments by the Western financial system. And so it's sort of an artificial default. And again, this is one of these policies that is just going to backfire, and it's going to hurt the people who are implementing this block on payments because, if Russia is being prevented from making these payments, what do they care? It's the Western bondholders of Russia who are not going to get their money. So, how this is going to actually affect the Russian economy, it seems like it'll probably be a minimal thing, but it's a good talking point, I guess, for the Western financial media. And a lot of this stuff, the Russian default, all this talk about capping Russian oil revenue, the $600 billion infrastructure program, a lot of this, I think, is also just kind of a distraction. These Western politicians, especially here in the U.S., they are facing their own domestic political problems as a result of rising inflation and rising prices, which is really starting to hurt consumers, and voters are getting upset about that. Approval ratings are declining, and even Fed Chair Powell just kind of threw the president under the bus recently. This is a story where he claimed that Putin is not the one responsible for rising inflation. And I mean, that's obviously the case. We've had rising inflation for much longer than this conflict has been going on. But it shows that there's a little bit of political disunity here on the home front as well. And I think that that has a lot to do with why we're seeing all these kind of weird token moves by the G7 and by Western political leadership. It is something of a distraction. And speaking of domestic politicians, here we have Governor Newsom in California. This is his plan to fight inflation: distribute more stimulus. Yeah, they're going to be sending out inflation stimulus checks in California to the tune of about $1,050. I think that's the maximum amount. You can get that if you've got some dependents and you make under $75,000 as an individual, or $150,000 as a couple, and then going up from there in terms of income, you can still get a check. I don't know exactly where it caps out, but it's a diminishing scale. But so the vast majority of people are going to get these inflation checks. If I have to explain to you why this is like throwing gasoline on a fire, then I don't think you understand how inflation comes about, because of course, as they give consumers more money to drive up demand, that is just going to stoke higher prices moving forward. And, expect more of this. I've been seeing in other stories, they've been talking about doing more federal stimulus checks. And, if things get really bad, I wouldn't be surprised if we see something like that, because, people just don't understand how inflation works. And the country is addicted to easy money at this point. The economy is. And as a result of the stimulus that we had over the past couple years, direct payments to voters are now more hooked on easy money than ever. And so, even if it means higher inflation moving forward, I think people just are going to want that next hit of cash. And so moves like this are going to be very politically popular, but they're going to make the problem a lot worse. And then back to the situation in Europe, not only is the economic warfare getting cranked up, but we're seeing the U.S. increase troop levels to 100,000 in Europe. And there was also talk of getting this quick reaction force of 300,000 soldiers, which is a lot more than the U.S. currently has available for the European theater. So, all of this is going to cost a lot of money, and war is massively inflationary on its own. In fact, a war is one of the most inflationary things an economy can go through because they're very expensive and they tend to get financed via borrowed money. And so, when you have a war, the government tends to just create all this money out of nowhere, and it devalues all the currency that is already in existence. And this time is not going to be any different. We're already in a proxy war in Ukraine, and so we're already sending billions of dollars worth of equipment and resources over there, and all of that is being paid for via the printing press. The U.S. doesn't have this huge war coffer of cash to pump into a war in Ukraine, but they do still have the printing press. And so, to the extent that this war expands, it's going to get a lot more expensive. And, God forbid NATO comes into direct conflict with Russia, then you are going to see the costs really mount. I mean, never mind the existential threat of a nuclear war or something like that breaking out, but even if it's just conventional warfare, guaranteed this is going to get very expensive. And so this is all going to be leading to much higher inflation moving forward. And as far as the economic warfare goes in Europe, the German economy, this is from express.co.uk. Here's a headline about how their economy is really suffering, and consumer confidence in Germany has been predicted to reach an all-time low in July as inflation is running out of control there. I mean, I think the last set of producer inflation numbers we got out of Germany was something like 33.6%. So obviously that is not a sustainable pace of inflation, and this is going to lead to a lot of economic pain in Germany. And keep in mind, Germany is the largest economy in the EU, so any major blows to the German economy is going to be felt throughout the region. And you know what they say, when goods stop crossing borders, troops will. And I think that's exactly what we are going to see here in Germany. Now Russia is cutting off the flow of gas to Germany. The EU has sanctioned all of these products from Russia, and so the economic ties there are beginning to be severed, and that is going to increase the likelihood of open conflict between the EU and NATO and Russia. And the global economy is also experiencing significant disruptions as a result of this conflict. Here's the latest story. Ecuador could stop pumping oil within 48 hours due to protests, and this was from yesterday. So we might see Ecuador's oil cut off from the global supply very soon. And they don't produce a tremendous amount of oil. It's about 500,000 barrels per day that Ecuador produces, but the total amount of oil produced in 2021 total world output was about 95 million barrels per day. So, this is greater than half of 1%. And in a market that is already stretched very thin and is already very tight, every barrel counts. And so, this is political unrest in Ecuador due to inflation, due to lower living standards. And one of the demands of the protesters is actually that there's no more expansion of oil production and no more mining. And so, any way that this goes, there's going to be less oil coming out of Ecuador. If they get the protests under control by meeting the demands of the protesters, that means less oil. And if the protesters remain unhappy, they're going to disrupt oil production there as well. And it's not just Ecuador, we're seeing this all over the world. I covered a story a couple weeks ago about how Libyan oil production had collapsed due to instability in the region and because of fighting militias in Tripoli, the capital. And normally, Libya is producing about 1.5 million barrels per day. So, good chunk of world production, more than 1%. And they had dropped their production down to about 100,000 barrels because of that fighting. It had recently gone back up in recent weeks. I think they were back up to around 800,000, 900,000 barrels. The fighting is kind of ebbing and flowing. But now they're saying that they may suspend oil exports from key terminals entirely because, again, of the unrest there. And, if you're the leadership there, you're not really thinking about exporting oil when you've got a bunch of AK-wielding militias at the door of the, governmental buildings. You've got bigger things on your mind. And so, until the instability in Libya gets resolved, we're going to not see a lot of oil coming out of there either. And, taken individually, all of these developments are somewhat maybe minor. I mean, it could still affect global prices, but when you have all this stuff kind of snowballing, there is a cumulative effect that is greater than the sum of all the different things. There's an exponential effect when you begin removing oil producers from the global picture. And I think it's likely that we'll see more and more of that as, one, global food prices continue to skyrocket, and that always leads to a lot of unrest. Inflation is continuing to skyrocket, so it's not just food, it's everything across the board, fuel, energy, consumer essentials, all of that stuff is getting more unaffordable. The folks affected most by inflation, they're affected disproportionately by it, are the poorest people. And so, there's a lot of people around the world who get by on very minimal incomes. And when you start to see even the little purchasing power that they have eroded, they're going to be real unhappy. And so I think we're going to see more and more of these disruptions to global supply chains. And of course, that is going to lead to more inflation. So it's sort of a vicious cycle where these developments feed upon themselves. And just one more example of global unrest to show you it's not just Libya, it's not just Ecuador and Sri Lanka now. I mean, they've been having riots and problems there for months now. Pretty much ever since this conflict started, they have been experiencing significant inflation and devolution of their economy. And now they are announcing that non-essential petroleum sales have been halted for 2 weeks. So, that's not going to help to assuage the unrest. And I think this might be a preview of things that we may be seeing coming to a town near you pretty soon. We might see rationing, we might see outright shortages of oil, and sure, it's painful to pay $5 a gallon at the pump, but it's a lot better than just not being able to pay any price because there just isn't any gasoline to go around. And as these problems persist and get worse and worse, I suspect that we may be seeing something along those lines. Maybe if the government in the U.S. Tries to implement price controls or something like that, that could really be the final nail in the coffin for the availability of fuel. And, when government starts implementing price controls, shortages are what you see. And so it's not outside of the realm of possibilities for this to happen here. And finally, here's the last story I want to cover today. Michael Burry, he's the famous investor from The Big Short. He made, tremendous amounts of money from predicting the subprime crisis in the U.S. back in 2007-08. And so, he knows a thing or two about economics. And now he is warning that this bullwhip effect, you might have heard about that, is possibly going to contribute to a Fed reversal in policy. So the bullwhip effect, just to give you the short version, it's basically we've had these supply chain disruptions, really low inventory levels among retailers, and so they've been putting orders out in advance, trying to build up their inventory. Well, now they've got the inventory, but now consumers are being squeezed by inflation so much they don't have the discretionary funds to go out and purchase, these items, TVs, furniture, what have you, non-essential items. And so the inventory in retailers, your Targets, your Walmarts, your Home Depots, all those places are at record levels now. They're skyrocketing. And so this could lead to deflation, not deflation in things you actually need, like in food or energy, but a huge deflation in these kind of more discretionary consumer goods. And that could lead to a lot of economic pain in and of itself. And so, Michael Burry is saying that the Fed may need to reverse policy to stimulate some demand for these goods. And I do think that that is exactly what's going to happen. The Fed is eventually going to be forced to reverse policy. And I don't know if that is going to be because a recession hits in the U.S. and we've got to send out stimulus checks because people are addicted to easy money and stimulus. Right now, the Fed, it's been promising that it's going to get inflation under control and it's going to lower inflation. And people believe that. It seems like, when you look at the gold and silver market, it looks like investors are not pricing in high inflation down the road. That could be attributed to maybe normalcy bias because people have never seen massive runaway inflation. They've never seen an inflationary depression, so they just don't think it can happen. Could be because of optimism and irrational exuberance because of the massive bull market that we've seen in stocks and real estate and all these other assets over the past decade or so. It could be because people are just flocking into the dollar in kind of a mania. The dollar might end up being the tulip of 2022. So it's hard to say, but the fact is that, you can ignore reality. You can believe that the Fed is going to get inflation under control, but it's like Ayn Rand said, you can ignore reality, but you can't ignore the consequences of ignoring reality. So eventually, it is going to become obvious that the Fed is not going to be able to lower inflation. They are going to have to reverse this tightening. Like I said, maybe it's because of recession, maybe it's because of a war. And maybe it's because they have to finance a war in Europe for the U.S. Maybe they have to finance a more expansive proxy war or possibly a direct conflict. Or maybe they'll reverse because of the bullwhip effect, like Michael Burry is saying. It's hard to say exactly what is going to be the ultimate catalyst for the Fed to resume an easy monetary policy, but it is going to happen. And, if the economic pain gets bad enough, people are going to be putting tremendous political pressure in place for this to occur, because even if prices are rising, they're going to demand more stimulus. And I think they're going to get it. And, when that happens, when the Fed reverses policy, that is going to be the moment that I believe all of us who have been stacking sound money are going to be awfully glad that we did. And that is the big picture from all these stories I covered today. Inflation is going to get a lot worse regardless of what the Fed says. The Fed also told us that inflation was transitory. They told us it had peaked. None of that turned out to be true, and I don't think it's going to be true that they are going to be able to get inflation under control. And there are many, many signs pointing to the fact that inflation is going to really continue to rise, and it is going to be getting much worse. And that, when it becomes obvious to investors, is going to exert a tremendous upward pressure on gold and silver, the traditional inflation hedges. And I think the idea that crypto is an inflation hedge now is pretty much been dismissed. I mean, obviously, crypto, not the store of value it was advertised as. See, it might still be a speculative asset. It might still be something that, becomes a viable force in the economy in the future, but it's not a store of value. Anything that loses, like 75% of its value over the course of less than a year, it's hard to say how that can be considered a store of value. So I think investors are going to be turning to gold and silver in a very big way when this inflation begins to really run out of control, which is coming. We might see a little bit of deflation in the CPI or something like that in coming months as a result of, the bullwhip effect and a slightly slower economy. But a year from now, I expect inflation to be a lot worse than it is right now. So let me know what you think in the comments down below. Thank you all very much for watching. Don't forget to like, comment, and subscribe, and I will catch you next time. Smart Silver Stacker, out.